It's Brian Preston, the Money Guy.
So let's talk about, now that we know that credit scores go beyond just getting debt, it actually impacts your day-to-day life with insurance, utilities, your job, putting a roof over your head. Let's talk about the components of what makes good credit. What goes into your credit score?
And I think what's beautiful is if you kind of know the recipe, if you know what causes your credit score to go up or down, you can kind of, tell me if I'm wrong here, but you can kind of influence. There are some tactics you can implement that'll make your credit score a little bit better if you kind of know what goes into it.
Yeah, it's interesting. FICO score is what you are measured by your creditors. And FICO stands for Fair Isaac and Company. And these guys, they are the judge, the jury. They determine what you're going to be, how you look out there to the lending as well as insurance companies, these financial world people that are coming and looking at you. So since they are the most important people, you can understand why they keep their recipe. What goes in is a secret. It's top secret on what goes into it.
Like Coca-Cola.
But they do share some of the big things that are going on. And you need to sit up in your seat and take notice of, listen to this number. They testified before the House Financial Services Subcommittee that 10 billion decisions worldwide were determined by FICO scores. 10 billion.
Was that
that's with
billion
a
with a B?
Billion. 10 billion per year of financial decisions were made based upon these FICO scores. So you are involved in that $10 billion number. So it makes sense to at least understand what goes into a good FICO score. So let's just go through this. This is what they've released publicly, and then we're going to try to give you some tips and tricks on how to modify and make sure that you're doing good behavior that's rewarded with your credit score. So the first thing, and these are the two first components I'm mentioning, are the most powerful and make up close to 2/3 of your credit score. So you got to get these first two dead on if you want to have a good credit score. The first one is payment history. It's 35% of your credit score comes from your payment history. So you need to make sure that you're consistent, that you're making timely payments. You don't want to have payments that are paid late.
And I think what's really interesting is that just one late payment, just one missed payment can have a huge impact. So it's really, really important that you do pay on time, you pay consistently, because one misstep can be pretty significant.
Yeah, and we all make mistakes. Look, I think it's a common thing that everybody, because we're humans, we make mistakes. I would say if you do miss a payment and you get fees, you get interest and all these things put on, if it's your truly first or second one and these happen so rarely, I would recommend call the credit card company or call the lender and say, let them know if there's something in life that's going on that kind of led to this behavior. Maybe you had you moved recently, because these are the common things. You've moved, you had a sickness or illness in the family, something like this. You'd be surprised if you could go ahead and reach out. You might not only save your credit, but you might also save yourself some penalties and fees. So definitely understand being proactive and an advocate for yourself will help. So the second thing is credit utilization. 30% of your credit score is determined by credit utilization. And the best scores typically average around 7% utilization, but 10 to 20% is considered okay. Now, what we mean, because that's probably, what do we mean by credit utilization?
So credit utilization. Now, this is just looking at revolving credit. So it's not looking like your mortgage or anything like that, but it looks at how much available credit do you have. So you think in terms of like a credit card that has a $10,000 limit, how much of that limit are you utilizing on a consistent basis? So if you only have $100 that you're keeping on that credit card at any given time and there's a $10,000 limit, that's pretty healthy.
Right.
If you have a $10,000 limit and that thing's maxed out every month, you're probably not helping yourself from a utilization standpoint.
This is a big one. I will tell you something. It's kind of, because of technology, it's made me a little neurotic, is that because if you get, and I'm going to talk about in a minute when we get to monitoring and keeping up with your credit, you're going to be able to see what the credit rating agencies see from, when you get some of these services, you can actually see what they're seeing. And it annoys you when you see, you pay your credit card off monthly, but when you look at their credit utilization calculation and you notice, wait a minute, they're saying I'm using that. I know I paid that off 3 weeks ago. Remember, this thing is in a delay. So what it leads to, here's the neurotic behavior. And I know there's a lot of Money Guy listeners that are doing this because you tell me this stuff. I pay my credit cards probably twice a month. I don't mean, it's just like I'll be watching TV, watching probably some reality show, and I'll be like, time to pay the credit card. I got money in the bank, so let's just pay them because I want those utilization rates to look as low as possible, especially after you've had some big months. It makes sense, and I get it. It's because you try to pay those things down as fast as possible so it doesn't look like you're using more of your credit than you actually are.
And, we talk about it all the time. We are obviously a wealth management firm here. We think we have, the best advisory team in the whole world when you look at all the folks we have here working. And one of our advisors, Carter, who you guys have heard us talk about a lot of you work with him, he actually called each one of the agencies, each one of the credit card companies to find out when they report, like what day of the month. And he has teasers set on his calendar that he pays it the day before they report because he does exactly this. And I just think that's so incredible. But he has a really great credit score because he's willing to go that little extra step.
Because you heard us say that the really good scores are around 7%. Well, if you're using your credit cards, it's easy to see how you can get above 7%.
Sure. Yep.
I think what Carter does is really smart in the fact that he's also, it's kind of a phantom to the credit card companies because I'm sure that utilization rate looks pretty close to zero, even though he's using the services because he's making sure he pays it down every month before they report it.
Yep.
It's a smart planning strategy if you think about it. And that's what I love. It goes into our team. I mean, we walk the walk here at the Money Guy Show. So you get into that nerdiness when you work with us. So the second, these components get a little smaller, but still very important. The third one is length of credit history. That's 15% of your credit score. You need to keep, I have a credit card that I opened. I didn't get my first credit card until after college. That's probably a big mistake. If I could give you guys advice.
Well, that was so long ago. I'm sure.
Yeah,
it was way back there, right?
Let me keep those old credit lines. Here's the first advice, and then I want to kind of take it into a slight sidebar, is that when you're in college, it's a unique time, is that credit card companies are trying to get access to you.
Sure.
They feel like you have low risk for multiple reasons. First, you're in college, so they think, okay, this person's going to be gainfully employed, make decent income, so we want to go ahead and grab them while they're in this formative stage of their life. The second thing is most people who are in college have parents that will kind of step in potentially. This is the way the credit card companies, I'm not saying, we didn't have parents that were going to step in, but I'm just saying this is the way they look at us if you're stereotyping a group of people in college. So the credit card companies look at you like you have less risk while you're in college. So that's why now they've changed the rules and laws. I used to be surprised at how many kids at University of Georgia were lined up to sign up for a credit card for a free bag of potato chips that you could go to the grocery store and buy for 89 cents at the time, because you could get all, if you had a loyalty card or whatever. But there would be kids lined up for these credit cards. I realized after I graduated college, it was much harder to get a credit card than if I would have signed up. But my parents had me so scared of getting a credit card that I didn't take advantage of it. Yeah. Now, with this said, let me give you a cautionary tale. If you are going to sign up for the credit card in college, do not lose your mind. I mean, because your credit limit's probably going to be $1,000 or $2,000 because you don't have a lot of income. Don't go fake your life. Don't fake life starting in college and then get a bear that's going to sit on your shoulder because you have all this debt and the interest and everything else. Because credit cards are definitely dangerous instruments like a knife that you have to be very careful as you're using them.
Yeah, length of credit history is one we see people a lot of times inadvertently harm themselves. So they hear that every year you can go out to annualcreditreport.com and you can pull a free copy of your credit report, and they go do that and they say, oh man, I've got this credit card listed here that I opened up back when I was in college, and I should just simplify and consolidate my financial life. So I'm going to close down everything I'm not using. Well, even though that's very well intended, and it sounds like a great idea, if you do shut down some of those old credit lines, and really, you just want to leave open the single oldest. You don't need 10 credit lines from back there because they just look at the single oldest that you have. So I would recommend keeping that open. You still need to keep an eye on it and make sure you're monitoring that account. But even if it's not something that you still use, it makes sense to leave it open. And we see people do that all the time where they close it down inadvertently.
And here's another planning opopportunity. It just came to me. We didn't even have this in the show notes. Because I've done this. My first credit card was a Six Flags credit card. Because, it makes sense. When you're 22, 23, where are your priorities? Let's go riding roller coasters, obviously. But as I've gotten older, I didn't go to Six Flags as much.
Right.
We kind of changed that. So I didn't want to close the Six Flags credit card because that was my oldest one.
Right.
So what you can do is that you can call realize a lot of the credit cards are run by the same banks. So you can call that credit card company, the main one, and say, look, I'm currently in Bank XY's Six Flags card. I don't really go to Six Flags anymore. Does Bank XY have some sibling credit cards that maybe have a benefit that would, be better for me at this stage of my life? And I was able to keep that credit line open, still keep the age of it, but transition it to a different credit card with some different benefits that was more useful. And it's a win-win for everybody. You get to keep that old credit line open. But for the credit card company, you actually probably will now start using this credit card again. So that's why they are definitely have some motivation to try to help you with that transition. So that way you just don't have an abandoned credit card out there. Because we don't want to open up too many of these things, but it at least keeps everything as efficient and productive as possible.
Well, and that's a great segue. You said you don't want to open up too many. I think what the last two are pretty small. The next 10% of your credit score is made up by how many credit inquiries you have, how many lines of credit you have out there. So just like you said, that person in college that was signing up every time there's a free T-shirt or slice of pizza were really hurting themselves. So that's one. You just want to make sure you don't have tons of inquiries out there applying for new credit because it makes it look like you're in trouble.
Yeah, and be careful around those life transition moments. As I mentioned, I've already kind of given one clue. Mortgages, when you go buy a brand new house, there's so much incentive, or it feels like life happens so quickly, is that not only do you have the utilities pulling on your credit line, you have the mortgage company pulling on your credit line, and then you need to buy furniture for the house. So you have that potential, because they say, oh, hey, if you sign up for our in-store credit card, we'll give you, 15% off your bill or 10% off your bill, and you don't pay any payments for 7 years. And you're like, how is that possible? But they're pulling off your credit. All these things add up. If you're doing 3, 4, 5 new lines of credit, it looks like you are trying to go and get so much money that it makes your lifestyle look like you're in jeopardy.
Yeah.
So be very careful on those new lines of credit. And as you've already said, that's 10% is the new credit. And then the last is credit mix. There's the last 10%. They want to see a mix of success from people having revolving credit and installment loans. Revolving credit are your credit cards. That's like a credit line. It's sitting out there. You have access to a certain level of money that you can borrow off of. So that's your revolving credit. And then installment loans by the way, when you're young and you pay off your first car loan, your credit score will pop. I mean, it can pop.
Yeah,
I've seen it where I know for me personally, it's nice when you pay off something you can see, because I think when in the beginning, it makes it to the credit agencies like, oh, this person does fulfill their obligations. Sure. Now, if your first loan is your car loan, it can have the reverse element. If it's your oldest line of credit fell off, that could hurt you based upon length of credit history. But if that's not your oldest loan, it should hopefully help you out.